What's up, BAT family? Welcome back to the Builder Trader YouTube channel. In this video, I'm going to teach you guys how to trade gold. I'm going to explain my exact strategy, full breakdown, step by step, exactly how to approach gold day in, day out, week in, week out, so that you guys can make consistent profits. Not only that, I am determined to make this the best gold strategy video on YouTube, all inclusive, to make it so that this is the only reference that you need to be able to trade gold and to approach the market consistently. If you're brand new to day trading, this video is not for you, as a lot of these concepts are going to go over your head. However, feel free to check out this playlist right here. This playlist will give you the foundation that you need to be able to start understanding these concepts, and then you'll be able to start trading more advanced assets such as commodities like gold. Without further ado, let's head to the charts, and I'll see you guys there. What is up, BAT family? Here we are on the charts right now. We are looking at gold. And if you do not know how to get your chart to look like this quite yet, do not worry. We will be starting on a blank chart and going over exactly how to get to this point, how to analyze trades using technical analysis, as well as some fundamental analysis such as news events throughout the week and month. Now, a few things about me before we get started here. I have been day trading almost 7 years now. My experience started back in November 2017, and so right now we're around 6.5 years, and this upcoming November will be 7 years for me. In addition to that, I also hold my Securities Industry Essentials certification, and currently about to be getting my Series 65 FINRA license, which will allow me to be a registered investment advisor. So I'm not just a typical retail trader. I have quite extensive knowledge on the markets and quite extensive experience. So as you can see here, we're on the gold charts. First things first, you're going to want to use TradingView. If you're not already on TradingView, then you definitely should be. You need to be taking notes or following along on how to do this for yourself. So if you're just watching on your phone, then you may want to try to move to a desktop or have TradingView open. That way you can utilize both windows. In addition to that, we need to discuss how pips are calculated with gold, as well as your margin, on how your broker calculates margin. Now, if you're not familiar with how gold moves, it's very, very volatile and has a lot of volume. And one more quick point regarding TradingView here before we get fully started is that there will be some features that I will be using that are only for TradingView Pro or for the paid version of TradingView. I do recommend paying for TradingView once you get your feet wet a little bit and kind of understand how to navigate and understand how everything works. It is absolutely worth it and needed, but the free version could get you by for the time being. Alright, so to calculate pips with gold, if you're unfamiliar with doing so, this is how you would do it. And the best way to do it is by creating a demo account with your current broker to understand how much the commission is for the lot size, what the pip calculation is for that particular lot size, as well as how much margin is required to open that particular lot size. Those three things, and that can be done by opening a demo account completely free without incurring any type of financial loss. All right, so the next thing is the price range tool. I have this tool already favorited. However, to get to it is going to be on the left-hand side, and you're going to choose price range under the measure section here at the bottom. All right. Just a quick time check, 7:27. All right. Next, after selecting that tool, you're going to go to a candle and measure how much it moved for. All right, so the candle we're looking at is going to be this one right here on the left-hand side, this big one. This big bullish black candle, okay? So from the low to the high, the bottom of this candle to the top of this candle says, let me get it exactly to the top, it says 32,207. Now that represents a $32 price movement because the low of this is 23.21. The high of this is 23.54. You add 32 plus 0.2 plus, the 23.21.8. You end up getting 23.54. Now, 32 represents 320 pips. Okay, so how do we get there? All right, let's back it up real quick. So this is where you maybe want to take notes if you're unfamiliar with the pip count on gold, okay? So first things first, pip stands for percentage in points, if you're unaware of that. And 1 pip on gold is equal to 10 cents. A 10-cent movement in price is 1 pip. Okay, so for example, if gold moved from the price we're currently at 23.42, okay, so it's at 23.42.4, by moving up 10 cents, or sorry, in this case 40 cents, 23.42.4 up to 23.42.8, it's a 40-cent movement in price, okay, and this is price moving in real time right now. A 40-cent movement in price is 4 pips. We get that because 1 pip is equal to 10 cents. All right, so on a 0.1 lot, on a 0.1 lot, on $1 pip, which is typically what it is equal to, depending what asset you're trading, what pair, and how your margin and brokerage is set up. But that 1 pip would be equal to $1, okay, on a 0.10 lot, depending on your brokerage as well. Next, 10 pips for gold. Here, let's make some space between here. $10 pips for gold is equal to a $1 movement in price. All right, so if gold moved from $23.42, I'm sorry, $2,342, $23.42, where price is just currently at right here, and went down to $23.41, a $1 movement, that is equal to 10 pips. Okay, so on a 0.1 lot, that is equal to $10, because on the 0.1 lot, it is $1 pip. That's the calculation for that lot size. Now, if you're following along, you should already know what 100 pips is. 100 pips is equal to a $10 movement, okay? I believe you should be following this now. And this is just for gold. You can calculate this for every other asset by doing the same exact thing and testing it on a demo account on your brokerage. That's how you're going to do it risk-free and get the exact valuations for everything. So 100 pips, $10 movement on gold. If gold went from $23 or 23, I keep saying 23, it's not at $23. If gold moved from $2,342, $23.42, up to $23.52, a $10 price movement, that would be 100 pips. If gold went down from where we're currently at, 23.41.1, okay? And we went down to 23.31.1. That's 100 pips, okay? Now let's do some bigger movements here. This particular point, back where we first measured, right back to this point, $32 price movement, $32.20 equals 322 pips. You get it? 32 is equal to a $10 price movement, a $32 price movement, 300 pips, $2, 32, $2, 20 pips, 20 cents, 2 pips, okay? 322 pip movement, all right? Now that you understand the pip calculations for gold, let's move on to the next step that you need to do when analyzing this pair and understanding its price movements. We need to refer to some news resources, and those include economic calendars, which track the medium to high impact news events for that trading day and for the week. You need to be highly aware of these particular news events, as commodities, indices, and currencies are all highly impacted by major economic news. Now, one really good resource to use would be forexfactory.com. This is very common, and I'll have the link for that in the video description. In addition to that, I also use dailyfx.com and their economic calendar. It shows additional news events that are not shown on Forex Factory typically. It's always good to have additional resources to show you a little more information that other places may not. Okay, so for example, right now, today is April 8th. You can see here, this morning there was a news event at 8:15 a.m. We had the Swiss National Bank Chairman Jordan speaking at 8:15 a.m. during New York Open. And for those that are just now using this website, you may need to adjust your time. As you can see, I need to refresh this as it's not currently synced to my time zone. So it's 7:34 p.m. here. It's saying it's 9:58 p.m. and that's not correct. So here we are, updated at the correct time, and now the news events have been synced to my time zone. Now I know what time they're going to happen on based on my location. And that's how you're going to set it up for yourself. Otherwise, you're going to have so much guesswork figuring out what time, what news event is what based on your location in the world. It's very handy. So as you can see, a high impact news event we have this Wednesday coming up is Consumer Price Index, which measures is a leading indicator to measure inflation in the United States. Next, let's look at dailyfx.com. This is going to kind of show you an example of news events that aren't shown on Forex Factory but are shown on here. So as you can see, on Forex Factory for April 8th, all we saw was the Swiss National Bank Chairman Jordan speaking, but as you can see, there's additional news events here that you can refer to as well that are also medium impact news events and also impact these particular currencies. So it's good to be aware to utilize that, and like I said, both links will be in the video description. Understanding news and economic news is part of fundamental analysis, and you need to be aware of the overall fundamentals. You don't have to be a fundamental analysis expert when it comes to day trading, but you need to take them into account. You need to understand interest rates and how they affect the market themselves. Understand that during these particular high impact news periods, how the market's going to react, and then after that time frame, how the market's going to move. There's a lot of volatility involved at the time of these news events. So sometimes you have to take that into account and understand that you may need to sit out until that particular event has settled, till the dust settles essentially, and then execute your particular trade or entry. Sometimes news events can influence your particular setup and may take you out prematurely just based on taking liquidity, which we will dive into a little more here later on in this video. But overall, you need to be highly aware of the medium to high impact news events for that particular trading day, for that particular trading week, and plan accordingly. If you fail to prepare, you prepare to fail. Okay? So let's go back to our gold chart here. Here we are, all marked up. We're going to delete everything, and I'm going to explain to you guys the absolute importance of technical analysis. Now, for those of you that have been trading for some time, are already fully aware and may have a very strong technical analysis skill set already developed. And congratulations to you, you are ahead of the game, and that's what is absolutely needed to succeed, but not in and of itself. Technical analysis is just one piece of the puzzle, and really, you don't have to be an expert to make money, an expert at technical analysis to make profits from trading. However, to see long-term success and to improve your craft and to see increased profits, it is better to spend more time on the chart to get a greater understanding of how price moves, of how liquidity is taken, and how the market reacts at certain areas and at certain times. By doing so, you'll be able to capitalize greater on potential price movements and understand the market to a greater extent compared to the average person. Now, there are quite a few different technical analysis tools that I use, and the basic one that I use, most basic, is support and resistance. And now I'm not going to teach you guys how to place support and resistance levels. That's not the point of this video or even the technical analysis I'll be going over. It's a little more in depth than that, but that is one tool that I use and that I do recommend using for now. In addition to technical analysis, you're going to need two other key pieces to succeed in trading and to even succeed in trading gold. You know, it all goes together. Gold is its own beast. It's very volatile, has a lot of volume. It moves more than other currencies and other indices, other pairs. There's a lot of volume, a lot of money in this particular asset. So you have to understand how it moves and understand the complexity of it. In addition to that, you need to have a trader's mindset in order to succeed. You need to have a growth mindset. You need to understand that little gains add up. You need to understand that sometimes you're going to fail and you have to keep pressing forward. You know, you're learning this today not to give up when the time gets hard. You know, you're using this information to help you succeed, you know, and learn from your mistakes. You're going to mess up a lot, especially, you know, I myself messed up a lot and, you know, didn't think I would be susceptible to such things, but I was. And, you know, it's a whole entire growth process. And if you do not change, and if you not work on yourself, if you don't focus on improvement, if you're not your biggest critic, you're not going to succeed. You have to hold yourself accountable. You have to be a businessman or businesswoman, and you have to be driven. You cannot see failure as failure. You have to see failure as another chance to learn, another chance to improve, another opportunity to try again. So that's one thing that you need, a trader's mindset, a growth mindset. In addition to that, you will also need strong psychology. Now, mindset and psychology are entirely different when it comes to trading. By psychology, I'm referring to over trading, over risking, being greedy, being emotional, not taking profits, you name it. Not managing a risk, you know, the list goes on and on. But your psychology is going to be the most detrimental factor when it comes to trading, and when it comes to your success, and when it comes to your success to trading gold, just day in and day out, or with analyzing the chart, it comes down to your psychology. And if you're trying to just force something, paint a picture that isn't there, you're going to fail. So psychology is huge. It goes hand in hand with your mindset. You have to improve day in and day out, week in and week out. And if you don't hold yourself accountable, and if you don't truly try to improve, if you don't truly try to work on yourself and your flaws and your limitations, and you know what makes you susceptible to mistakes, then you're never going to succeed. All right, so I'm going to hop off my high horse now, and we're going to start diving into technical analysis. So as you can see, I place some support and resistance levels here, just kind of the main important ones that I'm seeing here off the higher time frames. So on the right hand side, I'm on the weekly chart, and as you can see, the chart is split. To use this feature, you do need to have a paid version of TradingView. Okay, on the left hand side, we're going to the 4-hour time frame. Now when looking at this here, on the right hand side, you see where these support and resistance levels are, and you see how they line up on the lower time frame, the 4-hour chart. Next, the most important things that I am placing and marking off would be my areas of supply and demand, my previous week's high, my previous week's low, and those are also known as your areas of liquidity. We're marking off our areas of liquidity, okay? So right here we have an area of demand right here, okay? Right here we have a little retest area, but it's also an area of demand for this point right here. If I were to move this over, area of demand, right? Next, we have an area of supply here, where price currently is reacting from. This is also our weekly high, based on how the price action currently is for this week. And this is our previous week's high. Now for the purpose of this video, we're going to just mark off the previous week's high despite where price currently is. So this was our previous week's high before price opened to start the week here. And I can use the bar replay mode so you guys can see here. This is where we were to start the week before market open on Monday, today. So you're going to mark this off, your previous week's high as PWH, previous week's high, okay? You need to mark off these areas of liquidity, these major points of high, major high and low points, as these are going to help you keep track of where the market's going to go and understand the overall range that price may move to or break out from. Next, as you can see, down here is our previous week's low. Right here. I'm going to mark that off as PWL, previous week's low. Okay, simple as that. We have our area of demand marked up next here. So as you can see, price is at where we were to start the week here. I'm going to draw a minor level of support here as this is on a lower time frame. Now we only utilize these minor levels on the 1 hour, 2 hour, and lower. They're just short-term areas of structure. You can use these points for take profit points and also areas for potential momentum trades. You know, when these areas break, they're good entry opportunities to catch the move to the downside or upside depending what point you're entering at. Alrighty. So we just started our markup for the week. Okay, we're going to pretend that nothing's happened so far. We have our previous week's low marked, previous week's high, areas of demand, area of supply, or any minor points of structure that we're looking at. Okay. So now what? What else do we do here? Because we're not quite done. Okay. Now there's another tool that I utilize, which is also very common. It is the Fibonacci retracement tool. Now that particular tool, I do not use it how most people normally would when it comes to day trading. I did used to use this tool quite often, but from there I have learned to utilize this my own way in how to find overall points of take profit for the higher time frame trend. Okay. So as you can see on the right hand side, we're on the monthly time frame. Each one of these candles is 1 month, one whole month of data. Okay. To properly utilize a Fibonacci retracement tool, first you're going to go to it on the left hand side here. It's the third one down under Fibonacci, first one Fibonacci retracement. Now I do not recommend using this tool for anything other than what I am showing here. Now you can definitely utilize this by doing your own back testing and using this on an intraday time frame. However, I found that I would focus on too many different things and not what actually mattered when I would use this. Okay, that's why I only use it for what I'm showing you now. So to properly place these tools, you're either going to place them from the higher low point all the way up to the push, the highest point of that particular move, and vice versa. If you're measuring a bearish move, you're going to start from the highest point that price made all the way down to the lowest point that price made. So the lower high point down to the lower low, and for a bullish move, the higher low point up to the higher high. Okay. So in this point, we're going from the higher low point up to the higher high. Okay. This entire push here. Now don't focus on the 38.2, 61.8, none of these retracement reversal levels, those don't matter. We're focusing on these take profit points, these extension areas, Fibonacci extension points. This area here where these green lines are, these particular points show where the overall trend on a higher time frame may reach. Okay, so as you can see on the monthly time frame, it took all this time for this move to play out to all the way where we're currently at the top of the negative 61.8 Fibonacci extension. Okay, the price point was 2,356. Okay, so as you can see, price is, well, it has hit there, but since we use the bar replay mode, at the left hand chart doesn't show that yet, so I will be showing that in a moment. But as you can see here, utilizing this tool can give you an overall idea where the overall higher time frame trend is headed. By doing so, you can align yourself with the intraday trend, understanding that you're going to align yourself with the overall higher time frame trend to have a higher probability of getting into a winning trade. Okay, this is called top-down analysis, and if you need additional resources regarding that, I do have other videos that indicate how to go about this process. You can watch that on this playlist right here. However, moving forward, we're going to remove this tool. Okay, I only recommend using on the monthly, weekly, daily, and sometimes the 12-hour. That's it, just the higher time frames. Like I said, it can work on the intraday time frames, but I don't use it for that. It may get you caught up in and looking at information that really isn't going to help you. And that's the biggest thing. Too much information is going to distract you, and ultimately trading is meant to be very simple. The act of buying low and selling high, meant to be very easy. But we complicate trading by our own emotions and by forcing things and by being emotional and not having proper psychology. Okay? It all boils down to that. Now, let's back it up here. On the right hand side, we're going to the weekly time frame. Left hand side, let's utilize this bar replay tool. Okay, so this is the start of the week. I'm going to go over to the chart that I already have marked up for our weekly analysis that I've done. But we're going to look at this point right here, the overall description of what I was saying. And we're also going to go over some examples too. I'm going to break them all down on how to catch these setups. There's a wide variety of different setups that you can trade, but we're going to go over some of the signals that I called here in a moment. Some of the signals that I've called these past few weeks in my Telegram channel. Now look at this here. Before the market even opened, okay, I had said price is looking to continue higher to go up to 23.50 to the 23.60 price range. I stated that we may see a pullback down to the 2300 level of previous resistance, which may be acting as support, and we may even see the area of demand down to possibly the fair value gap at 2290, which I can explain what that is in further detail here soon. But it's just another point of liquidity. So from there, we may see a move higher, a continuation higher, and then I said it's possible price may open the week with strong volume and continue higher, meaning that opening bullish without a pullback, or I stated that it does appear we will see a move down before moving higher. Okay, risk reward tools for the setups. All right, so this is them. Let's use the bar replay mode real quick here. Alrighty, so, oh, whoops. Accidentally just jumped to the real time, but just showing you guys this so you can see how it played out at the start of the week and how you guys can analyze and do this on your charts too, okay? So next candle, boom. Market opened very bearish. We came down, retested a 2300 price range. We didn't fully hit 2300, but we hit 2304, okay? In trading, you have to be very flexible. Price may not always come to the exact price point you think, but it may come to a particular technical area. Now, you need to use these areas as your entry points or areas to analyze where you could potentially enter at. But it's okay if price doesn't come down to exactly 2300. Look where it hit. It hit our previous area of resistance. Now it turns support, and you're finding reasons, finding clues to enter at this particular point at these areas of tactical interest. You can call these areas of liquidity, but they all are different depending on what the technical is and where it's located at on that particular chart, okay? So let's look at the next candle. Came down, bullish candle, bearish candle, and then had a massive move all the way up to that point here, 2350, okay? Up to 2354 even. Now, as you can see on the right hand side, that's the top of the zone here. You can literally analyze these moves ahead of time with high probability, high accuracy by using top-down analysis and utilizing the tools that I have just shared here. Now, as you can see, my charts are pretty plain. I don't have too much on them. Just literally support and resistance, supply, demand, and what I'm about to draw here next is a fair value gap. I'm going to make this gray. Actually, for simplicity's sake, we're going to make it blue. Okay? Now, it does not matter what color you make your zones or make your technicals. For me, I personally like using these gray and blue colors. Now I use them interchangeably. If I create my previous week's high and previous week's low using this gray color, then all of my intraday and lower time frame supply and demand levels are going to be this blue color. However, if I, make the PWH, PWL as blue, then my intraday levels are going to be gray. That's just how it is. For me, it makes sense, and I understand what I'm working on, what I see, and so for me, colors don't entirely matter. Just as long as you know, and as long as you can see the charts and the price action, that's what matters the most, okay? So as you can see here, price hit that level and absolutely rocketed up, okay? So how do you catch a move like that? It's one thing to analyze and see where price may go and make your charts look all nice, but it's another thing to actually execute. So let's go into these examples here. Now, like I said, there's lots of different trading examples. If you want more examples or want to learn more and about different setups, feel free to join my Telegram channel. I also offer a B.A.T Academy Telegram channel is what it's called, B.A.T Academy. It's where most of my students are in, and there's also a community channel for us as well in there. And we all just send our trade setups and knowledge, and I also have a playbook which shows all types of different trade setups that are high probability that I use. Okay, so what we're showing now is just a few of them. And these are all ones that I called that were successful these past 2 weeks. These are the only ones that I've called the past few weeks. We've had no losing trades in the past 2 weeks on our signals because we're only calling a few. Quantity is low, but quality is high. And in trading, you want high quality over high quantity. And that's really what matters at the end of the day. Money in your pocket. Okay, so what I've just drawn here is called a fair value gap, this FVG. Okay, I'm going to go over this real quick as I don't want to overload you guys with too much information. But what a fair value gap is an area of liquidity. They're typically at areas where price has broken out from or rejected from, but in this case, broken out from, and as you can see, it's left a large wick. There's a major wick rejection here. So for these particular movements to happen, price sweeps liquidity that introduces a large volume movement and often leaves a lot of room for price to come down to fill. Okay, you can call that a gap if you'd like. But many times, price often comes back to retest this area and either has a continuation move, goes all the way up, or just has a reaction from it, but it's still high probability trade, and then continues in the overall direction it was headed. It really depends, but these particular areas are high probability trade setups that either you'll catch a continuation move or just a bounce move, a reversal or counter trend. It really depends what direction the market is moving. You can consider fair value gaps intermediary points between supply and demand. They are just usually previous areas of breakout points. So as you can see, there's a lot of confusion that happened here. Price left a large wick, but it ultimately broke out between this point and continued higher. Okay, I can show you another example of a fair value gap real quick, but we're not going to really dive too much into it. We're mostly just going to show the trading examples, okay? But another fair value gap that one could, use or see on particular charts are as such. Right here, same thing, price broke out, gave it a retest, and then continued higher. It's not necessarily an area of demand, because an area of demand is on the extreme side, the low end of candles. Supply is on the high end of candles, the extreme side where the wicks are. A fair value gap is that median point, okay? So right there, you can find another one. Let's see, just real quick here. Right here, this would be one for a bearish move. On a lower time frame, there's something right there, so we can just look at it real quick. See? You could draw this as an area of supply if you wanted, but it also can be seen as a fair value gap because this is where price previously broke out from. As you can see, it was right here, broke below, similar to our other example I just showed, came back, tapped in, rejected from. Okay, sometimes, like I was saying, those are high probability areas. Price will move in your favor and either continue in that direction or may come back up again, but they're good short-term trade setups. Okay, so now let's go into our trade examples here. So we're going to be utilizing the bar replay mode a little bit, but we're going to be going to a different chart now. Alright, so this is the chart that we just made. I'm going to go to the chart that I made for our weekly analysis that I sent in the Telegram, and also show these particular setups. So let's remove, actually I'm going to keep this on, move this to the side, as we'll be going over that example next on how I caught this move last week. This move was based on the, what news was that? The ISM PMI, the Purchasing Managers Index news last Wednesday. Yeah, Final Services Purchasing Managers Index. Then shortly after, Fed Chair Jerome Powell spoke. Now let's take a look at that chart. Okay, so as we had discussed, and I had shown on the prior chart on the bar replay mode, how price moved down and tapped that level. Well, this right here, this text in that blue box, indicates what I had analyzed before the market opened. Okay, so as you can see, price came down, retested, hit this level, and absolutely took off and went all the way to the full take profit point. Now, how could one have utilized that particular setup? How could one have taken advantage? How could he have executed? This is how. So the time frames that you can use to execute, I recommend using the 4-hour, 2-hour, 1-hour, 30-minute, even down to the 3-minute. Now, utilizing this is called time frame correlation, but it's used as such. You're looking for particular price behavior, particular behavior by the candlesticks to indicate that you have timed the particular move that you're looking for properly. Sometimes you may see a move and you may enter prematurely based on particular price or price action, and it may be too early. So this is a good example right here. Right where we have this particular candle I have marked off, and this one here, this bullish candle. Let's say you saw this particular candle here and you're analyzing that price is going to hit this level of support, previous resistance, and continue higher. Okay, but as I had mentioned earlier, you need to be flexible when it comes to trading, and sometimes price may not hit exactly where you think it's going to. So you see price reject as you did on this bearish candle. See that it didn't make a new low and then made this bullish candle, printed that bullish candle. Naturally, or at least in my mind, I would still want to execute this trade as well. Price didn't fully reach here, and you know there's a good chance it's going to start rallying, going higher now. Okay, let's just say you entered on the next candle. You had your stop loss. You can have it below this point here. For simplicity's sake, we'll just call it below that higher low point where this bearish or where that bullish candle is. You know, your buy signal right here. We'll have it below that. And this is where liquidity comes in as well. Oftentimes, before a move happens, liquidity needs to be taken in one way or another. And that's often done by inducement, which is, how do you get induced? Well, this is an example of inducement. Price reacting a particular way without completely coming to that technical level, and if you really look at it, it's not as it should look. If it was really going to react from there, liquidity need to be taken. Or, as you can see here on this right-hand side, you would see a big bullish candle like that, indicating strong strong volume and that buyers are in control. Okay, so look, you took that trade setup, price moved down, and then tapped onto that level of support like you were thinking, but this time you got stopped out because you got in too early. Okay, so you took a loss here. How could that have been avoided, and how could you see the right signs to enter on this setup here? Well, one, you could have made your stop loss wider. So with gold, expect to have drawdown on most of your trade positions, on most of your entries. It's very volatile, so sometimes it'll push another dollar or two or even more. A $5 to $10 drawdown, 50 to 100 pips, is okay on gold. 100 is pushing it. 50 to 70 is ideal. $5 to $7 drawdown. $10 is probably the extreme and the most drawdown you should incur, and as wide as your stop loss should be. But you know, it may be necessary for some of these trades, especially if there's news during that time, or if the low for the day is that at that point based where your entry is, then then that's proper. But you have to analyze accordingly, and you have to take proper risk to reward trades. So always a good rule of thumb is a 2 to 1, a 2R trade. You're risking 1 to gain 2. So for example, 1%, risking 1% to gain 2. And that's basically the rule of thumb for what you want to take for trade setups. Obviously, the higher risk to reward, the better. And you never want to have a negative risk to reward. You never want to have a negative risk to reward. Less than 1-to-1 trades, 1R trades are risky, and you're typically risking more for them when you're entering them, although they are higher probability because you can just scalp and close and profit. It leads to bad trading habits. And just take it from me, okay? So you got stopped out. One way to avoid that is you could have still taken the trade, set up there, wider stop loss, maybe below this point back here, to potentially mitigate the fact that price may come down and retest one more time like it did right here, okay? However, if you waited patiently and saw that, this is what you needed to look for to take that entry point right here. This is where you can utilize a lower time frame, but I don't recommend it unless you are proficient at it. But you need to utilize the technicals and utilize how the candles react from that point, okay? So as you can see, we'll go down to 3-minute here. What happened? I'll show you. Something very interesting happened to indicate that price is ready to go. It took liquidity, okay? So as you can see right here, this is that bullish candle I was showing on the 30-minute. On the right-hand side, we're going to go to the 30-minute, so you can just see the play-by-play on the lower time frame. All of this needs to line up on the 3-minute, 15, 30 to line up with the higher time frame to catch that overall bigger movement that you're seeing. That's the only way you're going to catch these bigger trades. Otherwise, they're just going to be shorter-term scalps, a few candles and 10, 20, 30, 40 pips, which is good. But this is how you catch those overall bigger movements, and they don't always play out. You have to adapt. Sometimes you have to utilize your scalping abilities, your scalping skills. Sometimes you have to utilize, taking what you get, not what you want, and accept the profit that you have and not be emotional. Sometimes you got to let the trade play out and walk away, not even micromanage it, nothing, just let it move. Okay? You have to utilize your skill set, and depending on how you want to manage these trades comes down to your own personal preference. Because remember, at the end of the day, as a trader, your thinking needs to be flexible. You're like a boxer, weaving in and out, throwing a few jabs, ducking, bobbing, weaving. You have to, okay? There's no right or wrong way to trade. However, there are more probable ways to analyze and execute trades and ways to maximize and capitalize more on particular movements. But there's nothing wrong with catching 10 pips every single day. That can make you money. If you're making money, that's great. There's nothing wrong with that. Most people are losing, okay? So don't get it in your head that, I only caught 10 pips, that's it. No, don't think that at all, okay? You need to start somewhere. Catching 10 pips consistently, you may find that it can be risky. You may not be able to think that quickly, okay? Well, if that's the case, then maybe start switching to more intraday type of strategy. People say whatever fits your preference. The only way to know your preference is by backtesting and demoing and going through the processes I'm showing you now. Everyone's minds works differently. there's some people out there that are able to capitalize on multiple different candles on movements because they're seeing like, okay, just went down, it's going to pull back, I'm going to enter again up here, and really capitalize on just this trend right here, just this whole movement right here. Some people can literally do so very quickly in real time. Push, exit, oh, enter again, boom, I'll pull back, enter again, can catch that, you know, and that's difficult, but that's a very high level of trading, very high level of scalping ability, but it's risky. It's risky. Why? Because of these things right here, especially where it lines up on a technical level, especially if liquidity is taken with high volume, like as such right here. This is your indication that price is ready to move higher. So you're going to execute. You're looking for that signal to buy. You know, you didn't buy over here. You were waiting patiently for price to come down to 2,300. It didn't, but it hit the zone and it hit the level of support, and that's what matters. Okay, so one could have entered right down here, been confident on it, been like, yep, that's it, I'm going to make my stop loss right below that low point, which you can do. And sometimes price may react as such and then come down, take it out, and then go. Okay, that's called taking liquidity, a liquidity sweep. It also may not do that to the full extreme like that, but it may do so as such, like on this bullish candle right here. This one with the long wick, that could have been your entry candle, and that also was your signal that price is going to continue moving higher. That was your confirmation. So one could have entered on that bullish candle that pulled back right afterwards, or you could have bought at the high. You know, in this case, it doesn't really matter too much. It would have just gave you a better entry price. But at the end of the day, you know, like I said, having a 50 to 100 pip drawdown is normal on gold. So if you can stay within that range and have a logical stop loss below the previous low point, then you're fine, okay? But if you miss the boat, then you have to understand, you have to wait for the next opportunity. So in this case, if you were to enter on that pullback right here, you would have had a nearly 50 pip stop loss, $5 stop loss. That take profit point, you would have had all the way at this first point here, 23.30. And then even 23.50. But first, let's back up a bit here. Why was this your entry signal? Why was that your confirmation? Because look, price broke below this previous low point, and that's typically not what happens when price maintains higher highs and higher lows. When price does that, that is typically your confirmation price is moving the other way. And if you look on various time frames and in various areas, you'll see that happen over and over and over. It happens every single day, multiple times a day. Those are the points you need to look for. That type of candle behavior, you'll notice it. It'll move very quickly, then go the opposite direction. It will flip, do entirely different than what it was showing, and will leave this often strong wicks behind. Those are your clues. Okay? So now that you have an understanding of how candle behavior needs to look, how liquidity sweeps kind of look, now is understanding where to take profit, and there's a variety of ways to do so. Like I said, you can just exit if you're in profit. But if you're looking for areas, technical areas to maximize and exit on and make a little more profit than just some quick scalps, then this is how you do it. So as you can see, where our previous week's high was, where this blue line is, this level of resistance. Let's go a tad lower here on the 30 minutes so we can see our risk reward tool. Take profit 1. Why? Because your previous week's high is an area of resistance and an area of liquidity. Price may not break through that point on the first go, okay? And as you can see, price hit, rejected, which means buyers took profit here because it's not certain that price is going to break through that point. It needs a lot of volume. As you can see, it did. But if you would have been holding on to that, and if price rejected from here and then came all the way back down, you would have felt silly and you wouldn't have made any money. And that's not the point in trading. The point is to pad your pocket. The point is to make profit. The point is to execute consistently. So that would have been your first take profit point. This area of resistance, previous week's high. Your second point would have been that overall projection level that you saw, that we listed, that we saw earlier at 23.50. Okay, that particular zone on this chart here. See? That would have been your second take profit point, as that's not guaranteed. And to manage the trade, you would have either close half or 75% of that first take profit point, your stop loss would have been moved to break even, and even possibly trailed below these lows here. To really take advantage of a trailing stop loss, you should do so in the 30-minute time frame based on the 30-minute candle lows. Now, although there may be larger spread as there's more volume in these candles, so you may want to utilize a lower time frame to trail more tightly, although it could take you out earlier. The 30 minutes relatively safe. There's a lot of room, and you can kind of see it early on just based on the candles. But you could be giving up some extra profit by waiting for those candle closures. So just keep that in mind. But as you can see, typically on the 30-minute candle, if the move is going to go, it doesn't come back. Okay? So that's how you could take advantage of these particular moves here. Close all at that first take profit, call it a day. If you're trying to catch the bigger move, you got to manage it properly. Trail the stop loss below the 30-minute candles or even the 15-minute. But sometimes 15-minute candle lows get taken out and then price continues its overall trend. It may need to come down and retest one time. It depends on where you entered. Once again, if you caught the real move, it goes. But if you caught the move and it needs to come back down and retest something, between sessions or after a news event or before a news event, then, you may risk getting stopped out beforehand. I'm going to go over just a few more examples here as this video has gone on kind of long, but I want this to be very inclusive for you all. Like I was saying, I want this to be a very strong resource for you guys to refer back to on how to trade gold and, give you guys the foundation you need to really help you out when you're in need here. Next would be this move right here. This particular trade I had called last week. I can show you real quick. But here we are. I had called enter 21. Oh, sorry, that was 2 weeks ago. We'll go back to the most recent one, which is this one here. Enter 2272 between 2272 and 2276. Stop loss 2266. Take profit at 2290 and take profit at 2300. That's what I saw here. So as you can see, entry price 22. Is that 73? But between this range here, this zone here. Oh, yep, we have it marked, that blue zone. That was our entry price zone. This was our stop loss, 2266, which is below right at this wick here, the extreme point. But most likely price wasn't going to go back down to there based on our price action here. Example here. Thanks for bearing with me this far. If you've stuck through this entire video and watched up to this point, congratulations. You have learned a tremendous amount of how to trade and how to approach the markets and how to approach your own charts and apply this strategy for your own day trading. Good work. Most people would have stopped after the first 5 minutes or even less. But those of you who chose to invest your time into learning and to your education, it's going to pay off. Like I said, I have had thousands of hours of chart time now and have watched hundreds, thousands, well, maybe not thousands, but hundreds of hours of, back testing, YouTube videos, strategies, this, that, and the other, and, investing your time into your education goes a long way. Lastly, these examples right here, I had called this setup approximately 2 weeks ago. Right here, though, let's go back so you guys can see for proof. This was April 3rd here. By 22, wait, no. Perhaps a little further. Oh yeah, yep, 3 weeks ago. Here we go, right here. So let's look at this gold trade here. Right here. Entry price 2168 through 2170, stop loss 2163, take profit 2185. Here's what I saw at that moment in time. As you can see, this is the same exact area we're at right now on the chart. But this is what I saw here. Price made this price was looking like this at this moment in time on the 1 hour and 4 hour, and again on this chart with it labeled here. This is the setup, stop loss below that low point, and take profit 1 at that overall high. At that overall high and that overall level of supply, that level of resistance, that particular area, that's what we were looking at. So as I had stated, and as you guys saw, our first take profit point was at 21.85, and we did not quite reach it, but it was this area of supply right here. Okay? So this is what happened here. We had taken this setup right here, 2168 through 2170. So this particular price zone right here was our entry price point that I had given. Stop loss at 2160. Where did I say that I put it? Stop loss 2163, so that was at this point down here. And we are looking at this risk reward tool right here, guys. This one right here that I'm clicking on. So when we look a bit closer, you can see that when I had called the trade, we had some drawdown, which is fine. So if you entered at 2169, 2170, 2168, you would have had a 40 to 60 pip drawdown. Entirely normal, totally reasonable. Okay. After that, price shot all the way up to 2178. From there, it came all the way down, as you can see. From there was another opportunity to take the trade, which was this point here. But I had instructed to exit as we had already secured quite a good amount of pips here. Let's take a look at this. 2176. Yeah, it looks like I had instructed to close at 50 to 70 pips. Alright guys, so this is the setup right here. Anyways, I digress. Here we are. On to our trade setup here. So I had called this back in March, as we can see, March 24th right here, by 2168 through 2170, stop loss 2163, and take profit 2185. So this is this risk reward tool right here when where I am clicking. So when we look at this setup, I had initially called to enter over here at this point in time. This was during pre-London Open, and I had set our stop loss 2163 as shown in the signal. So right below the level of support, I was anticipating on this area to hold, which it did, and there's a level of demand right here that I had saw at that moment in time. So the extreme end, the extreme area. And if this particular point would have broken, then it would have gone significantly lower. So this point was extremely important. Not only that, at that point in time and at this area, so this was our entry zone right here, where this particular blue zone is. This price point, as you can see, entering right over here would have been a little early, but as I already mentioned, having drawdown is okay. So we had 60 pips, 40 to 60 pip drawdown, which is entirely normal, $4 to $6 drawdown. From there, we had a strong bullish movement, and as you can see, price went back to our entry zone and absolutely rocketed higher. It went all the way up to 2181, where then I had instructed to close around this price range, 2176 to 2177, this point here, this area where I'm drawing the zone. And why is that? Well, one, as I had mentioned previously, you have to be flexible with your thinking when it comes to trading. You can't fixate on a particular price point, especially when you see warning signs. And what were those warning signs? So let's see here. So yeah, as you can see, current time 11:07 p.m. For me, that is 53 minutes before London Open. London Open is at midnight for me here in Seattle, Pacific Standard Time. But as you can see, where's the update? Oh, right here. So my apologies. Move stop loss to break even. I'm going to close this trade as we have rejected from 2180, and I feel that this is a good time to book profits to find our next opportunity. Price 2176, take profit now. So right at this point here, we saw this rejection from 2180. If price was going to continue higher, it would have pushed all the way up to this point, which it did later on. As you can see, the following day, rocketed all the way up to 2200 that particular trading day. But from there, saw rejection. We were in a good profit. Saw that price may start to move lower, which it did, and it was a good decision to close the trade in profit there. But had I fixated on the overall take profit, which it did go to, I could have, but had I moved my stop loss to break even, I would have got taken out, got taken out of the trade with no profit, break even, and then would have missed this move. So it is wise to adapt, as you can definitely take the same opportunity once again, which, as you can see, this risk reward tool, I did not call the signal, but as you can see, it absolutely played out all the way up to the particular price take profit point at 2185, and same exact price entry point. So some trade setups you can take again, especially if you're seeing an overall move. Sometimes it takes a few different push phases for it to play out. So as you can see, it took one push, came down to retest, make a higher low point, then continue higher. So sometimes you can trade both of those moves if you are able to recognize rejection and able to recognize or candle patterns, or not necessarily candle patterns, but certain candle behavior and rejections, and on top of that, be able to understand where the next potential entry point would be, and this would be, in this case, a fair value gap or a potential retest on the lower time frame, depending on your trading style and your trading education and what you have learned. But right here, minor area of support or a fair value gap. Remember, fair value gaps are points where price breaks out from and then needs to return as it leaves a particular space to fill on a higher time frame. So as you can see, price broke out, rejected, needed to come back down, needed more momentum, needed to take more liquidity for price to move higher. And right here, this particular wick absolutely rejected, took liquidity, and that is the fuel that was needed to make the market drive higher up to 2200. So that is all I have for you guys this video. I appreciate you guys sticking to the end. I hope you learned a tremendous amount. Remember to like and subscribe. Don't forget to join my free Telegram channel. And if you aren't already following me on Instagram, X, and TikTok, go ahead and do so, please. I hope you guys have a tremendous trading week. I hope you guys utilize this strategy and utilize the knowledge that I've given here. This is literally an all-inclusive guide. Use this, refer to this multiple times if you have to. It was meant to have a lot of information so that you learn and grow just from this one video. This one resource can provide a lot for you. You just have to invest your time. All right. Appreciate you guys and hope you have a great rest of the week. Peace.